Well, welcome to our weekly High Rock video. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. We're going to chat about what is happening in the global economy and financial markets and the world of wealth management, and how we are adjusting our investing strategy to all that is going on. And there has certainly been a lot of it.
A lot going on.
So in our models, Paul, we've not really been doing a whole lot in fixed income, although we did buy some U.S. two-year treasuries a while back as a bit of a safety valve.
Yeah, we did that about 2 weeks ago. We bought some, and we had a pretty good purchase on them. So we bought, as Scott said, like a safety valve. It was actually provide some portfolio insurance for us in case this thing really melts down. And we'll talk about it shortly, what happens to the yield curve in big meltdowns in risk assets like stocks. But we bought some U.S. Treasury, two-year treasuries, very short, considered kind of cash, but again, could provide some portfolio insurance for us. So that was one thing in fixed income. Away from that, in tactical, we did sell down some more hydrocarbon risk last week. As we mentioned, that really has not worked out the way we had liked it to. And being disciplined, we've used some stop losses and have liquidated a little bit more of that risk. And do you want to talk about what we've done in global? Because we've been somewhat active, certainly on Friday.
Sure. Well, basically, a couple of things. With the significant amount of volatility, and we haven't seen volatility like this since 2016, but before that, 2012. So volatility really spiked, and there was a number of factors that came into play. Certainly one of the key factors was that volatility had been so low. Certainly we've talked about the fact that the value proposition especially in global equities has not been something that's permitted us to participate in the last little while. We had a significant change in the value structure. We continue to see earnings ramped up for going forward, to a large degree based on the U.S. tax reform situation. But with the combination of better earnings outlooks and significantly lower stock prices, we're now back into a place where we're a little bit more comfortable getting involved in buying some equity. So a lot of clients who joined us more recently would have seen a fair number of purchases happening in there, or have added new cash recently, for that matter, would have seen a fair bit of buying as those opportunities presented us.
We should probably tell our listeners too that we were somewhat prepared for this, and we were even older clients that we had, including Scott and I. We're sitting on roughly 20% cash weightings and hoping for an event like this, and newer clients probably closer to 50% in that ballpark, or maybe even more in some cases, really new clients. So we were prepared for this, and we did do some buying, specifically on Friday, and damn near the bottom of the day, and things are up since then pretty substantially. So we had some decent entry points. But I think overall, do we want to talk about where we think things might go overall? Or
well, let's just talk a little bit about what volatility means to a degree. Certainly, one of the things that happens, and as we may have mentioned in the past, investors who borrowed to invest, what is called margin, using leverage, they would have had serious problems as the big moves would have initiated what we would call margin calls. And those margin calls just mean that their cash had to be put up against the investments that they had already borrowed to purchase, because the prices had come down so much. So what that does is it actually forces investors to sell. So it exacerbates some of that selling that we saw. And it's one of the reasons, not all the reasons, but one of the reasons certainly why stocks came down as hard as they did. Now, of course, there was they were significantly expensive, as we've mentioned before. And this whole new level has opened up what we would classify to be a lot of value. So we were in buying. We bought the S&P 500, both the U.S. dollar SPY, which is the largest ETF out there, but it's the S&P 500 index in U.S. dollars, and then we also bought the Canadian version of that, hedged as well. We bought non-North American equity index, we bought emerging markets index, and we bought some medium and small cap US index as well. So a lot of opportunity opened up for us, and as Paul said, we put orders into the market in advance, and we move those orders around according to what we think is reasonable value for those particular assets that we want to own. And it turned out that some of those prices came into line with where the markets were trading, and we were able to get some, do some buying.
Right. But overall?
Overall, I mean, now we're in a situation where it's a bit of wait and see how it manifests itself going forward. You can read all sorts of different market prognostications about what's next. I've read some good ones that say because the fundamentals are still relatively sound, that this may in fact be a reasonably good buying opportunity. So it's good for us to be participating. However, there is some technical analysis that comes into play, and some of the more technical market commentators have suggested that this level of volatility at a market top could mean that we've hit the top, and quite honestly could be starting to move the other way. So we have to be a bit cautious from that perspective. We don't want to fill our boots with too much, buying too many assets at this point until we have a better understanding of where we think we're going.
And it's still super volatile, even on Monday, and presumably it's going to remain that way for a while. So,
and that's something we have to wait and see, right, and obviously make determinations as we move forward as to what is in fact happening, and how, if this might affect the economy, the greater economy as a whole. What's going on in the world of bond markets, Paul?
Well, we'll get into some of the shapes of the yield curve have kind of changed fairly substantially over the past week or so, and I think we may have talked about this last or 2 weeks ago, but certainly I blogged about it when I was buying those US 2 years. When you get into these bad risk off periods, the curve does tend to steepen because there's a flight to quality or safety, and money transfers sort of from the back end of the curve in the 10s and 30s, 30-year bonds into the 2-year yield bond, and that steepens up the curve a bit. So there's been some performance in the very front end of the curve, and you can see the curves have actually steepened out a little bit over the past week. And
something that we've been monitoring, of course, and has a greater impact on the economy in general, has been that flattening of the yield curve. And now the fact that it's steepened out, it's a bit knee-jerk at this time, a little too early to say whether or not it's actually going to be impactful from an economic perspective. But a lot of this is knee-jerk, right?
Well, and a lot of what's happening, I mean, there are probably two things that were driving this sell-off in stocks. And you never know what's going to hit you. You never know what the event is going to be. If everybody knew it, it wouldn't happen. So the event over the past week or so in stocks getting hit globally in a hard way really was driven by, I think, a couple things. One, the fear that interest rates were going to go up. And again, we run correlation studies on various asset classes, and it was showing us that the bond market was not behaving the way it should have behaved against equities. So, and you've written about this numerous times, that traditionally government bonds should provide a bit of a natural hedge or a passive hedge to our equity exposure. And that has not been happening because in general, interest rates have been going up, i.e. government bond yields have been going higher because central banks are draining liquidity out of the system on a concerted basis. Now, that in itself, I think, made the equity markets very nervous. The other thing, as you mentioned as well, was low volatility. And there are all kinds of these new fangled ETFs that came out over the past number of years that were considered low vol trades, which means you made a small amount of money if the market behaved and volatility remained low. When volatility popped up the past week in a big way, those things got annihilated. Like I was reading one where it was up 193% over the past year, and it ended up down last week by 100%.
Yeah, and they had to close some of them.
Yeah,
they literally had to close them because
it's just incredible. So,
but just while we're on that point, one of the things that we try to differentiate, certainly from the way we approach markets, is that a lot of these products are basically just gambling.
Oh, totally.
They're not investing. I mean, we look at a market and we say, okay, where's value? We want to invest in value. And if we don't see value, well, then we're prepared to wait. Unfortunately, that doesn't go well with the short term
not always,
situation. But our view for our clients is a much longer term situation. And we want to make sure that when we buy something, we're buying value. So we may not get involved in what I would call the trade of the day. But the trade of the day was buying those low volatility products, and they blew up, right?
We'll never do that.
So we don't want to get involved in the trades of the day, Bitcoin, marijuana stocks, those kind of things. We'll let other people participate in those because we think there's more of a gamble going on there than actually investing.
Investing is about cash flows and discounting those back to today. So we're not investing in non-cash flow type stocks or bonds. A bond is a series of cash flows as well. So anyway, this market I think is going to remain volatile. And I think our view overall is that there are probably a lot of what's called trap longs up at the old highs from only a week and a half ago. And I think if we start getting back up there, we'll probably see a lot more selling. And I think that will create more volatility, or continued volatility, I should say.
Yeah, and then the reason that longs, as Paul said, get trapped, a lot of that buying that was done in January that actually drove the prices to fairly steep levels, that was a lot of what we call retail buying. So individual investors coming in and saying, well, everything's just going to continue going up and we're going to get involved. Now they bought, but they're trapped, as Paul said. And the human experience, the behavioral factors are that nobody likes to take a loss. Yep. And as a result, that money remains trapped because those investors don't want to sell it.
So when we get up near that high again,
they might look to take
just to get out of small losses. But nobody likes to take a loss. Yeah. But sometimes taking a loss is the best trade you do.
Yeah. In any event, the most important thing to understand is that a lot of this is really very short term in its nature. We'll try and sort out what it ultimately all means, but for our clients, we want you to remember that we're really looking at this with a much longer term perspective, and if there are good opportunities presented for us from a longer term perspective, we'll take advantage of them. But at the same time, we also want to make sure that we're doing the right thing and being cautious and being prudent.
Well, something we should add: entry points matter. So think about it. If you were one of those retail investors in the U.S. and you bought the Dow Jones Industrial Average of 30 stocks at its all-time high in January at 26,600 or whatever it was, you'd be down 10% last week anyway. Like that's not a good way to start out your investing create a portfolio. So
and this is where we think that we make a difference in what we do, because we do the work. We don't just take new clients' money and put it all into the market right away, as other advisors may do. We will do the work to determine when it is best to make those investments. And that's what separates us. Now, sometimes, again, we may not catch all the flavor of the day upswings, but we know that if we buy when it's expensive, that puts our clients in a very vulnerable position, and we just don't want to take that risk.
Yeah. That's it for me.
All right. Thanks, folks, for tuning in. Hopefully we'll be back next week with another version, but until then, enjoy the week. Happy Valentine's Day.
Have a good week.
Bye-bye.